We're in the process of catalyzing $1 trillion of investment in Canada over the course of the next 5 years. The first thing is that I was pleased to see that Canada remains the second strong, according to the IMF's forecast, the second fastest growing economy in the G7.
Ahead of new tariffs, Canadian dollar overtook yen as most heavily shorted currency. We need to talk about more than just some traders out there. We need to talk about something else and someone else.
Mark Carney has spent months telling Canadians that our economy is strong, investment is pouring in, and Canada is leading the G7. But while he was repeating that message, the Bank of Canada was cutting its growth forecast. Traders were building billions of dollars in bets against the Canadian dollar, and we now have evidence that a particular well-known company was already moving its money out of the Canadian dollar while Mark Carney was still chairman, proving even he was betting against a country he was about to lead.
Let's take a look. Ladies and gentlemen, this is a press release that the Prime Minister's office put out on May 24, 2026. And there's some quotes here, but I just want to take you to one particular quote.
We're in the process of catalyzing $1 trillion of investment in Canada over the course of the next 5 years in energy, transportation, data, and defense. We've launched our most significant regulatory reforms in generations to fast-track hundreds of billions of dollars of nation-building infrastructure projects, and we're realizing our full potential as an energy superpower.
So this is Mark Carney at the New York Club, and he was trying to convince pretty much everybody that investment was about to pour in to Canada and the Canadian economy. Now, he was saying things like catalyzing, and that's one of his favorite words, that there's going to be $1 trillion coming into Canada over the next 5 years. He has no basis of fact to actually talk about this because he's never been able to say where that is coming from, but he repeats the claim regardless. And he moves on to try to say that we're moving all of this money, we're building infrastructure, we have our major projects office, don't worry everybody. Never mind the fact that virtually nothing has been done.
Well, they appointed somebody who they're paying, what was it, like $600,000 a year to run this office?
Right.
That's about it.
Now, he said something else recently as well, and you've heard him say this, well, many times this year.
First thing is that I was pleased to see that Canada remains the second strong, according to the IMF's forecast, the second fastest growing economy in the G7.
Wasn't it the fastest growing economy in the G7?
Well, that was the goal, right? Canada's going to be.
Oh, excuse me.
They kept saying Canada's going to be the fastest growing economy in the G7. Now, notice that he started to say Canada's the second fastest, and then he said, according to the IMF, they're the fastest. Because, well, there's a specific reason that he said that. This is the document that Mark Carney keeps referring to. So this is the IMF report, and it talks about all these other nations. And you can see there where it actually talks about Canada's projected growth rate. It's around 1.5%. And there's no chart here, but we actually put one together for you. So here's the chart when you slot all these numbers. And this is where Mark Carney is saying Canada's going to be the second fastest growing economy in the G7, right? So Canada's there at 1.5%. But there's been an, update to that, everybody. We all know that Canada has been in a technical recession for the last couple of quarters because we have actually had a shrinking economy for the last 2 quarters in a row. That's the definition. Now, the Bank of Canada, you know that organization that Mark Carney keeps bragging about the fact that he was governor of and that he led Canada through the financial crisis in 2008, had nothing to do with Stephen Harper, had nothing to do with Jim Flaherty or anything else to do with the Conservative government. It was all Mark Carney. So they should be pretty important, right? They should be pretty trusted, right? Especially by Mark Carney, the guy who was the governor of them. Well, they've made an update to their forecast. So this is the report that we're going to talk about. It's Bank of Canada Monetary Report, and it's recent. It is July. What does the report say, everybody?
Economic outlook. GDP growth is expected to rise from 0.7% in 2026 to 1.8% in 2027 and 2028.
So it's interesting what this says, because this is presenting this as this is going to be positive news. But you have to pay attention to the first number that they used in this outlook, 0.7%. Well, 0.7% is their new forecast for 2026. So let's just take a look at this. So this is where the IMF had Canada. This is way back in April 2026. This is where the Bank of Canada has Canada, if you look at the new rankings for everybody in the G7. So Canada is not projected to be the second fastest growing economy in the G7. We're actually tied to be second worst. So Mark Carney should update his talking points, don't you think? We are now actually expected by the Bank of Canada to be less than half the growth that the IMF actually projected Canada to be back in April. You got to wonder what Mark Carney said to his buddies over at the IMF to actually make that projection, because it doesn't really cost them anything.
Well, in April, USMCA was up for renewal, and the talks hadn't fallen apart yet. I think that's one of the major factors.
Could be. So now the Bank of Canada has a forecast of the Canadian economy a lot lower than what the IMF did. And what this signals is they're not seeing this explosion of growth when it comes to the Canadian economy that Mark Carney is promising. If what he was saying was actually going to be coming to pass, $1 trillion of investment over the last 5 years, our economy should be booming. It should be exploding. We should be the fastest growing economy in the G7. Now, that doesn't mean we're going to be growing with more dollars than the United States, because they're much bigger and have a much bigger economy. We're talking percentages. So the percentage of Canada's GDP should be exploding if we're getting all of this investment. So how do we square this? What's going on between what Mark Carney is saying, what the IMF said, and what the Bank of Canada is saying? Well, ladies and gentlemen, all we have to do when it comes to a lot of things in Canada and in the media is we look outside of Canada to actually see what's going on. And this story blew our socks off. We were working on this last week.
We teased it on our live stream. This is our big story. And even we cannot believe the potential ramifications of what we uncovered.
I almost can't talk about this because it's so crazy. Ahead of new tariffs, Canadian dollar overtook yen as most heavily shorted currency.
Toronto, July 23rd, Reuters. Speculators raised their bearish bets on the Canadian dollar to the highest level among the major currencies in the weeks before U.S. President Donald Trump announced new tariffs on Canada, helping push the loonie to a recent 14-month low. New short Canadian dollar positions held by non-commercial accounts stood at $12.5 billion in the latest weekly data from the Commodity Futures Trading Commission that was released on Friday, days before Trump announced that 50% tariffs on a wide range of goods would take effect on August 19th. It was the highest net short position for a second straight week of any currency traded on the Chicago Mercantile Exchange, and the largest in the loonie since December 2024. Quote, speculators have been betting on Trump taking aim at Canada, end quote, said Adam Button, chief currency analyst at Investing Live. Quote, Trump has the penchant for brinksmanship that I assume will be part of trade negotiations, end quote. A weaker currency tends to help exporters, but it could also raise inflation and slow capital investment. Canadian Prime Minister Mark Carney is counting on increased investment to boost Canada's productivity. The loonie touched 1.4248 per US dollar, or 70.19 US cents last month, its weakest level since April 2025. Gee, what happened in April 2025?
You're right.
It has steadied near 1.41 since the tariff announcement as higher oil prices offset the increased trade uncertainty. Trump declined to extend the U.S. Mexico-Canada agreement, starting a decade-long clock to wind down the trade deal and pressuring Mexico and Canada to reach bilateral deals with the U.S. Speculators were unlikely to abandon their bearish bets ahead of August 19th, Button said, adding, quote, Trump will take the tariff threat, as far as he can go. He may even take it beyond that to a couple of days of implementation, end quote. U.S. Trade Representative Jamieson Greer said on Wednesday that he hopes to strike some interim trade agreements with Mexico and Canada this year while tackling thornier changes to the U.S. Mexico-Canada agreement in 2027.
So this is a graph when you compare the yen to the Canadian dollar and how much money is actually shorting the currency, which we will get to in a minute. And you can see the Canadian dollar is the orange line, and it peaked above the $12 billion mark while the yen actually decreased. So people are actually having more certainty in the yen versus the Canadian dollar.
The Bank of Canada has cut its 2026 growth rate forecast for Canada's economy to 0.7, down from 1.2%, pointing to uncertainties related to U.S. trade policy and the war in the Middle East. Quote, if you're bullish on the Canadian dollar, there's not a lot to hang your hat on, end quote, said Mark Chandler, chief market strategist at Bannockburn Global Forex LLC. Quote, productivity growth is weak. Economic growth has been soft, even if it's recovering, end quote. Foreign pension funds and insurance companies are buying Canada's federal bonds in record amounts, but those types of investors often hedge their foreign exchange risk and can be less sensitive than speculators to short-term price movements in the currency.
So that last part is important. So basically what they're doing is they're buying bonds against the Canadian debt. That's what they're doing. And this feeds into the statement when you hear Mark Carney say, there's all of this foreign investment coming in. So there's money that is buying the bonds of the Canadian government because they know it's going to be paid. They know the interest payments are coming in because it always gets paid. They just borrow more money to pay it. That's what happens. But the catch here is that that money actually doesn't go into our economy. They're buying the debt. So that money doesn't actually get used to make Canadian products, to improve infrastructure, to get businesses to come into Canada, but it factors into these statements that Mark Carney tells everybody that, we have the largest foreign investment per capita. Like, it doesn't count.
Investors expect the Bank of Canada to leave its benchmark interest rate on hold at 2.25% over the coming months, even as they raise bets on tighter monetary policy from the Federal Reserve. The gap between Canada's two-year yield and the U.S. equivalent has widened to 144 basis points in favor of the U.S. note, which is the widest since May 2025. Other major central banks, such as the European Central Bank, the Reserve Bank of Australia, the Reserve Bank of New Zealand, and the Bank of Japan, have already raised rates this year, while the Bank of Japan has intervened in the foreign exchange market to support the yen. Quote, the Canadian dollar feels relatively safe to short. There's less in your way, end quote, said Eric Breger, Director, FX and Precious Metals Risk Management at Silver Gold Bull, who is bearish on the loonie. Quote, you're not fighting upstream with central bank policy that could potentially run you over, end quote.
Okay, so there's a lot going on in this article. And it is tailored for people that understand finance, understand the market. If you've ever seen the movie The Big Short with Ryan Gosling and Steve Carell, no, they didn't give us money to plug that movie, but it gives you a sense on what shorting actually is. And it's actually a interesting dramatization of the 2008 financial crisis, and there is a lot of truth in it, despite the dramatization. Now, what they're talking about here is all of these other banks are raising interest rates. Bank of Canada isn't. And this is the kind of head scratcher that is going on in Canada, because they need interest rates to go down in order to increase people's propensity to actually spend money on loans and on the housing market, because we have this affordability crisis going on in Canada. So if you increase interest rates, that's going to make it more expensive for people who've taken out lines of credit to actually help them pay your debt. And it's going to be problematic for people that are trying to buy a new home or people that already have a new home and are renewing interest rates. So this is what the government is very skittish on, is interest rates actually going up. Now, this is where things get interesting. So we need to talk about something when they talk about shorting the currency.
So we've talked a lot about shorting the Canadian dollar, and it's important to give a definition as to what that is, how it works, and how it makes investors money. So basically in step one, what happens is the trader borrows Canadian dollars and then they sell the Canadian dollars at today's exchange rate. Step three, they wait around for a while for the Canadian dollar to fall. If the Canadian dollar weakens, it becomes cheaper to buy it back. And then what they do is they buy back the same amount of Canadian dollars, but they return it to where they borrowed it from and they keep the profit. So if you look on the right-hand side, a simple example would be to borrow $100,000 Canadian, and then you sell it when the Canadian dollar equals 75 cents US. So therefore you would receive $75,000 US. You hang on to that for a while. The Canadian dollar now falls to 70 cents US. And then you buy back that 100,000 Canadian dollars, but it only costs you $70,000 US. So now you're sitting here with an extra $5,000 US, and that's your profit.
So this is what's going on with the Canadian dollar. Why would places do this? Well, the Canadian dollar increases when the economy booms, because if the Canadian economy is booming, that means the value of the Canadian dollar is increasing across the world, and so the actual value of the dollar goes up compared to the US. This is what we compare our dollar to. But if the value goes down, that indicates a weaker economy. And so the fact that there's all of these traders around the world to the point of $12.5 billion, they're taking Canadian currency and shorting it. That means that they are putting a $12.5 billion bet that the Canadian dollar is going to decline. In other words, that the Canadian economy is going to continue to shrink.
And why is this bad for everyday Canadians? Well, because when our dollar goes down, it costs us more to purchase things. So when we have things coming in from the United States or from abroad, it costs us more to get those things here, and we have to pay more for them.
Okay, so that's what shorting the Canadian dollar is. Now, ladies and gentlemen, I wish this were the end of the episode, but it is not. Because we need to talk about more than just some traders out there. We need to talk about something else and someone else. Ladies and gentlemen, I present to you the 2024 Brookfield Corporation Annual Report. Who was chairman of the Brookfield Corporation at that point and asset management? Mark J. Carney. So if you look at the bottom here, so it says a portion of corporate borrowings are denominated in foreign currencies, which includes $2.8 billion Canadian in 2023 was $3.3 billion, payable in Canadian dollars, or $1.9 billion 2023, $2.5 billion. Okay? So what does that mean? So that means that Brookfield is doing something very similar to what these traders are actually doing. So back in 2023 and 2024, what Brookfield was doing was moving cash that they actually had in Canadian dollars out of Canada and into US dollars. What does that allow them to do? Well, it's similar to shorting, because if they move their money out of the Canadian dollar and into US dollars, that means they're anticipating the value of the Canadian dollar to go down, and
relative to the US dollar.
Relative to the US dollar. So then they hold on to that, and then when the Canadian dollar goes down even more, then they move it back into the Canadian economy and then buy a lot more Canadian money. And they get to claim a win on that. So this is what Brookfield has been doing, and this is what they've been doing while Mark Carney was still chairman. Now, I don't believe for one second, and I don't think anyone serious about politics believes for one second, that Mark Carney during the whole year of 2024 didn't know that he was actually going to be running for Prime Minister of the country. He would have been getting his affairs in order, and he would have been making his plans to actually move and resign from his position in Brookfield, setting up his portfolio, building all of his transition fund that he has, and deciding what investments he's going to do. That doesn't happen in a month, folks. So while he was at Brookfield, this is what the direction actually was. And it didn't just stop at 2024. 2025, Brookfield Renewable Partners. So you can see here, these are all in millions of dollars, folks. So this is a lot of money that is flying around. The thing to point out here is that in December 31st of 2024, just Brookfield Renewables, not the other companies in Brookfield, just Brookfield Renewables had around $79 million in foreign exchange hedged against the Canadian dollar. And they increased that significantly to $133 million.
Almost double.
Right. So that means that they forecasted that, you know what, the value of the dollar is going to go down even more. So we need to get our money out. And we need to make sure that we retain the value in that money as much as possible. So that is very, very interesting to me, and it should be very interesting to everybody as well, because these decisions, again, are not made on a whim. Brookfield Infrastructure Partners, folks. So we want to take you to this part of the report because this actually lays out in black and white what Brookfield's intending on doing here when it comes to moving this money around.
So we've highlighted the important part here. It says Brookfield's infrastructure's activities expose it to a variety of financial risks, including market risk.
And then it goes on to talk about currency risk, interest rate risk, and commodity risk and other price risks. So what do they do about that risk? They move money around. So this is where they've laid out in black and white that they've actually changed their position. And you can see from 2024, they had $142 million in Canadian hedged currency, or you can call it a short, even though it's not technically the same. And in 2025, that increased by 162% to $372 million. So this is a strong bet against the Canadian dollar and an expectation that the Canadian economy is not going to do well. In fact, it's going to do very, very poorly, which is why they moved their money around.
Well, and how would they know that?
That's a great question, Tanya. Here's the last page from this report that we're actually going to show you. And this is where it's pretty darn clear what they're doing. So you can see at the bottom here, it says, as at December 31st, 2025, our consolidated partnership capital of $35.5 billion was invested in the following currencies: United States dollars 46%, Canadian dollars 20%, British pounds 16%, euro 9%, Australian dollars 5%, Brazilian, and it goes on. And it says that 82% of our partnership capital is effectively denominated in US dollars. Period. And rates relative to the US dollar at the end of 2025 were higher than December 31st, 2024 for our most significant non-US dollar investments. So what does this mean? What this means is that it's not just these traders around the world, it's Mark Carney's own previous company that he was chair at. And while he was chair at Brookfield, they were moving money out of Canada, betting that the Canadian dollar would weaken. So why would Mark Carney, who was chair of Brookfield, direct or approve hundreds of millions of dollars that they actually had in Canadian funds to actually be moved out of Canada into US dollars, unless he knew or expected the economy was going to continue to go down, despite him all last year trying to tell everybody that Canada is going to be the fastest growing economy in the G7. That's what he opened his Liberal leadership race with, and that's what he opened the federal election with, despite the fact that not even 12 months before that, he approved moving of all this money out of Brookfield.
So this is how hedging the Canadian dollar at Brookfield can potentially help Mark Carney. So right now, we know how shorting works, how hedging against currency works, and that's what Brookfield's doing. So a Brookfield managed fund could profit if the dollar fails. We saw how they're moving the money around, how they are expecting it to fail. Brookfield could earn investment returns and performance-related compensation as a company from these choices that it's making with the currency. Then Brookfield Asset Management could improve its stock because it's making these good decisions for its clients and it is increasing in value on the stock market. And finally, Mark Carney's options will gain value in this scenario because Mark Carney currently has almost 500,000 stock options that he does not have to exercise some of them until 2034. Because Mark Carney is the prime minister and it's his policies and the Liberal Party's policies that are guiding Canada's economic future, while Brookfield is shorting the Canadian dollar and he has these stock options that he has yet to exercise, I think this is a huge conflict of interest, and Canadians need to know, is this on purpose?
Well, and here's the thing, folks. So let's just lay down the facts here, because some people will call these things conspiracy theories, especially when it's hard to have, specific proof. But what we do know is while Mark Carney was chair of Brookfield, you saw Brookfield engaging in this currency behavior and swapping. You saw that continue to a very significant degree when it came to the Brookfield Renewable Partners and the Brookfield Infrastructure Partners, and this is all part of the main company, Brookfield. So that continued into 2025. And you also see all of these traders around the world that are betting against the Canadian dollar to the tune of $12.5 billion. Meanwhile, Mark Carney has been telling everybody that we have the second fastest growing economy in the G7, according to the IMF. But his own Bank of Canada has actually slashed its projections by almost 50%, from 1.2% this year to 0.7%. That means that they didn't expect it to be this low. Investors didn't expect the Canadian economy to actually go into a recession, yet it did. But you have all of this evidence starting to mount. Mark Carney's words are not matching the results, and these results are actually now becoming documented in black and white when it comes to the Bank of Canada, when it comes to Brookfield's own balance sheet, and when it comes to the day-to-day lives of Canadians across this country. So is it no wonder that Canadians are starting to sour on Mark Carney and say, you know what, this isn't as advertised. But how can you have a prime minister that benefits from a weakening Canadian economy while also trying to tell everybody that things have never been better?